These mortgage REITs offer high risks and high rewards. Mortgage REITs can be highly risky, but they can also offer extremely high yields. AGNC Investment Corp. AGNC yields 14.2%. Annaly Capital Management. Annaly Capital Management yields 12.5%. Armor Residential. Armor Residential yields 18%. Let's dive in. Here are the 3 high-dividend mortgage REITs yielding over 10%. Welcome to Timely Investment Research. Real estate investment trusts are a great source of passive income, as they are required by law to distribute at least 90% of their taxable income in the form of dividends. As a result, REITs typically have higher yields than the broader market. Of course, along with high yields can come high risk. This is especially true for mortgage REITs. These trusts purchase mortgages and then use the monthly mortgage payments to distribute dividends. Mortgage REITs typically borrow money to acquire mortgages, which makes them highly leveraged. As a result, their 10% plus dividends should be considered highly risky. For investors willing to take the risk, these 3 mortgage REITs have high yields and could generate strong total returns. Number 1. AGNC Investment Corp. AGNC Investment Corp. was founded in 2008. It is a mortgage real estate investment trust that invests primarily in agency mortgage-backed securities on a leveraged basis. The firm's asset portfolio is comprised of residential mortgage pass-through securities, collateralized mortgage obligations, and non-agency mortgage-backed securities. Many of these are guaranteed by government-sponsored enterprises. The majority of AGNC's investments are fixed-rate agency mortgage-backed securities. Most of these are mortgage-backed securities with a 30-year maturity period. The counterparties to most of its assets are located in North America. Counterparties in Europe also represent a significant percentage of the trust's total portfolio. American Capital derives nearly all its revenue in the form of interest income. It currently trades at a market capitalization of $5.5 billion. AGNC reported its first quarter 2023 results on April 24th. It reporting a comprehensive loss of 7 cents per common share, including a net loss of 31 cents per common share and 70 cents net spread and dollar roll income per common share. The company also declared 36-cent dividends per common share for the quarter. The investment portfolio as of March 31st was $56.8 billion. The tangible net book value per common share was $9.41. AGNC issued 17.1 million common shares through at-the-market offerings, raising $171 million. Its record thus far has been fairly strong, with industry-leading total economic return, net asset value-based, and total stock return, share price-based. This outperformance has been driven by its highly efficient operating cost structure and the competitive advantage that it enjoys through economies of scale as one of the largest residential mortgage REITs. AGNC stock yields 14.2%. Number 2. Annaly Capital Management. Annaly Capital Management invests in and finances residential and commercial assets, including agency mortgage-backed securities, non-agency residential mortgage assets, and residential mortgage loans. It is one of the larger mortgage REITs in the industry with a $10 billion market capitalization. Annaly invests in and finances residential and commercial assets. The trust invests in various types of agency mortgage-backed securities, non-agency residential mortgage assets, and residential mortgage loans. It also originates and invests in commercial mortgage loans, securities, and other commercial real estate investments. Annaly provides financing to private equity-backed middle-market businesses and operates as a broker-dealer. On April 26, Annaly Capital Management announced its financial results for the first quarter. Annaly Capital Management reported a generally accepted accounting principles net loss of $1.79 per average common share in first quarter 2023. The company generated earnings available for distribution of 81 cents per average common share. Annaly had an economic return of 3% for the quarter and book value per common share of $20.77. Its total assets were $85.5 billion, including $77.6 billion in highly liquid agency portfolio. Annaly's generally accepted accounting principles leverage was 5.9x and economic leverage was 6.4x. The company also priced 4 whole loan securitizations totaling $1.5 billion in proceeds. Unlike most mortgage REITs, Annaly has a variety of other income sources besides the interest on mortgages. The trust is involved in loan origination, commercial real estate, and securities. In addition, Annaly is in the business of providing financing to private equity-backed middle-market companies and acts as a broker-dealer. This level of diversification is beyond what most other names in the industry have, which should help to protect the trust's business when interest rates are raised. Annaly Capital Management shares yield 12.5% currently. Number 3. Armor Residential REIT. Armor Residential was formed in 2008. The trust invests primarily in residential mortgage-backed securities that are guaranteed or issued by a U.S. government entity, including Fannie Mae, Freddie Mac, and Ginnie Mae. Armor Residential has a $1 billion market capitalization. Armor Residential reported first quarter results on April 26. The book value per common share was $5.44. The liquidity as of March 31st was approximately $550 million, which comprised $135 million in cash and $415 million of unlevered agency and U.S. Treasury securities. Armor Residential pays dividends on a monthly basis and has previously announced a May common stock dividend of 8 cents per share, payable on May 30th to holders of record on May 15th. Since its inception in November 2009, Armor Residential has paid out $2 billion in dividends. Since 2013, it has returned $280 million to common shareholders through share repurchases. Armor Residential's quality metrics have been volatile given the performance of the trust as rates have moved around over the years. Gross margins have moved down since short-term rates began to rise meaningfully a couple of years ago, although it appears most of that damage has been done. Balance sheet leverage had been moving down slightly, but it saw an uptick again this past quarter. However, we do not forecast significant movement in either direction from this point. Interest coverage has declined with spreads but also appears to have stabilized. Armor Residential has an extremely high dividend yield of 18%. Such high yields are often a sign of elevated risk, and Armor Residential is no different. Investors should forecast this risk of a dividend reduction into their due diligence. But for investors comfortable with Armor Residential's high risk and the risks of all mortgage REITs, the high yields could be appealing for income. Thanks for spending some time with us today, Timely Investment Research. We're so glad you did. If you found value in today's video, please give us a like, hit that bell icon to never miss an upload, and hey, don't forget to subscribe.